with an investment management firm, and onto the city, and as we all do, find our way, understanding which parts of the landscape you really enjoy the most. But often ended up working more closely with the private corporate sector, and that just leads to often dealing with problem solving. That's a lot of what we do, is problem solving for businesses. That's where I kept being drawn back to, and so that was the natural progression, was to build that aspect of the business. And that's what we've done today.
So looking at the firm itself, so if say an early stage business was to approach the firm, what criteria do you use to judge whether to help them, or to advise them, or to work with them, particularly given maybe a lot of them are quite young, they don't have the same sort of financial history that a lot of other firms do?
Yeah, and that is a good point to make, really. Where we sit again in the value chain, our particular focus is on businesses that do have market traction. Now, startups don't necessarily have profit. Many don't. In fact, I was speaking with an intern who we have today, and she was looking at Revolut, who is one of the big fintechs of today, and we were talking about valuing a company. Now, they don't have profit. Most of those digital challenger banks are yet to see a profit. Their revenues are really climbing. But point being, they were a startup, and in many respects they still are, because they haven't hit profit yet. So where we tend to sit is working with businesses that have revenue traction, may still be startups in that respect. There is the seed space, or the angel space, which obviously sits in the value chain before our position. So firms like that, the best way in my view for them to look at, wanting to get started, is to really get into that ecosystem of the incubators, angel investors. It's in there that you can learn so much about what the fundamentals are to really get your business going, and to prove that all the metrics, that all the fundamentals are there for someone to eventually invest in you. And they're varied, without going into too much specifics, but they're showing that there's a broad addressable market, so there's value in the marketplace, and that your proposition, whether you've got it up and running, yes or not, but that your proposition essentially solves a problem. It's that starting point, and then it's building it within that framework.
So how important would the team behind the business be to sort of valuing that business, or determining its sort of future potential?
It's very common to hear that, or to hear the phrase, we invest in the team as much as we invest into the business, or the idea, or the broader service. The team itself is pivotal, and that's for a couple of different reasons. One is obviously aptitude. Is the skill set there? Are the people involved proven in what they are doing? Maybe not within their own business, but in the past. But it's also team, as opposed to single person, can make a big difference, especially in the VC space. When you move out into the private equity or the structured finance space, it can be less important. But in the VC space particularly, there's got to be a team there, because if a VC is investing in a single director, single operator business, then they are investing in just one person essentially, and that becomes risky. So the team definitely is very important to have in place, and to show that they know what they're doing. A very good example is, many clients come to us and they are building a new business based on an app, and their idea, the service, is something that they understand, but the app and the technology itself They don't. So they go to a third-party app developer and they pay them to build it. Now, the problem with that is that third-party app developer, when you're a fintech, or when you're a tech company, I should say, if that third-party developer doesn't take a stake in your company, then they're not part of your team. And that becomes risky for a VC to invest in a tech company that doesn't have a tech person. As a very simple example, we see that a lot.
So you mentioned that one of the key problems within teams, sort of example, having the third parties. So Jasmine's asked a really good question of what are the key skills to actually be a good team player within one of these businesses?
I mean, that is very varied depending what the business is. So, you know, using the example of the app developer, if your business isn't app-based or isn't highly tech-based, and not all VC-funded businesses are, then, you know, it's less about that particular skill set. It could be more about your ability to manage growing businesses. That is a good example, actually, from firms like the early days of LinkedIn. You know, to take a behemoth, they brought in people who were skilled change managers. So they came from completely different industries, but it was more about the fact that they understood how to manage and grow very large companies. Often when people start up a new company, it's because they have a great product or a great idea or a great service or app. And it's one thing to have that and to get revenues, to get clients, and to get it going, but to scale that to then managing a team of 5 or 50 or 500, that management ability is a different skill set. So the point I'm making there is what you bring as a team player can be different for every company, but it's looking at what the company is, what it does, make sure that all the core elements of that are covered. Going back to the example of, don't be an app tech company if you don't have a tech person in your team, but through to other skill sets, you know, such as someone who can manage growth of your business, even if they're not particularly techy and your business is based on an app. It's all about understanding what your business needs to grow sustainably, and to capture your target market, to serve them effectively, and to make sure that what you're doing turns out the financial performance that you set out to achieve.
So you mentioned earlier the different institutions you've got very strong networks with, so the venture capital firms, the private equity firms. So given a company that approaches you for advice on financing services, how do you decide which investment group to take this company to link them with?
Yeah, and that is a very key part of day one for us. Often when a business comes to us and says, I want to get my hands on 500,000 or £1 million because I want to grow my business, the first series of questions that we go through are questions around what the business has been doing, what it wants to do, why they think they need money, and what they're going to use that money for. And it's not uncommon that as we go through that process, we then understand that there are different ways of achieving the growth, and their end goal is growth. That their end goal isn't simply to get £500,000 of investment in the bank. Their end goal is to achieve some sort of growth. So as we work through that entire thought process, their thought process, you can start to see, okay, there are different channels, different routes to get to where you want to go. Then we have to understand what the value proposition is of their business. Coming back to, we talked about the team, you know, what is the team in there? What is the market that they are approaching? Is it a very large market, and are they structured as a business so that they can scale massively across that market? If so, then it might be more of a VC focused investment raise, which would lead to the question of what is your target market and what is your particular service, because funds will have a sector focus or a few sectors. They won't necessarily be entirely broad. There are diversified funds that do just that. The much bigger ones, the Octopus Ventures, for example, has a number of silos. Equally, we might say this isn't pure investment, or this isn't suitable for pure investment. It's actually more of a structured finance, a structured debt solution that's going to work better. And there's in the investment space, there are hybrids all the way between that. There are venture capital style firms that work on more of a debt secured model with a partial equity stake, or what they call a warrant, which they will often take as an agreement for equity to accrue to them at the point that an exit or a sale of that business is achieved, through to straightforward debt, and then back across to straightforward venture capital investment. So the simple answer to that question is, we have to ask a lot of questions, understand what the business does, where it's going, and on that basis, we then choose the right lenders, investors to go and talk to. Oh, I've lost you. You're on mute.
Oh, mute. Here we go. So you've got companies coming from quite a wide range of background, different industries, and that must make it hard in some respects in terms of not being able to specialize as heavily as maybe in other roles in financial services. So does researching play a large role in private equity firms than maybe in other businesses?
Sorry, just to clarify that, does research in our position or in pure private equity firms?
In your position.
Yeah, where we sit again in that space, for us, it's a lot about problem solving. It's a lot about understanding the mechanics of the business. And that does require a lot of research, not just understanding how the business came to be, how it's operating, or are there further efficiencies that could be achieved, and where is the business going and what's the best way for it to get there. Those are all the mechanics. But it's also researching then to understand what the marketplace truly looks like, what the competitive landscape truly looks like. Because again, there's no point using the VC, as I know there's a strong VC focus on this call. Using the VC example again, there's no point taking a business that might be doing quite well, but is trying to raise a lot of money to expand into a marketplace where there's already a lot of competitors. We have to do our research to understand that. And if it is a marketplace that's highly competitive, so this business is not disruptive, is not new, then we're not going to go and sit down with venture capital firms, because we know from that market research it's just not suitable. So from that, we might say, okay, what do the financials look like? Potentially, it's not a venture capital opportunity because it is not innovative enough, but it's a robust business. So we can go to a private equity investor that we partner with, and they would quite potentially have more interest, as private equity looks as much, even more so, at the pure financials of the business as it does the ability to disrupt a marketplace. So yeah, certainly research, a lot of it, many hours before we can really do much. Often it's a couple of weeks of solid work before we even start speaking to investors.
So you mentioned that in terms of working really closely with the clients to try and understand their business. So does being able to have that really close contact with the clients, does that make the job more exciting, more rewarding, that you're sort of working with an actual team behind the business rather than sort of a face of a corporation?
Yeah, it certainly does. And most businesses that we deal with tend to be in the SME space. So as opposed to a much larger firm who you would hear about being advised by PwC, somebody like that, most of the firms that we work with will be in the SME space. So you do find yourself working with the leaders of that company. And you spend many hours. I mean, these days, of course, like this on Zoom. It used to be in meetings, but these days we're on Zoom a lot, and you do really talk through. You spend many hours each week talking through what the business is doing, and the feedback that we get from the market when we are negotiating investment terms. We talk all of that through with the people running the business, and you get to see the passion that they have for what they're doing, and you do, to a degree, get involved with what they're doing and how they're approaching it, helping to redefine some parts of how they run their business and where they're taking it. So if you enjoy that slightly immersive experience, then it's a great way to do business.
So has it made it harder during the pandemic to get to know clients about those face-to-face meetings, or are there actually some benefits of being online and maybe not having to travel so much, or anything else?
And that really is the key benefit, is not having to travel so much, and we can get through more calls in a day than you typically would. But of course, there is a real difference, as I think everybody's found on the social front, on the corporate front. It's very different having a meeting on Zoom that runs for 1 hour and then Zoom switches off, or whichever medium you might be using. That's a very different dynamic to meeting people, having a cup of coffee, having a chat. Often that might run into the evening, and it's much more personable. You're not on such a two-dimensional medium as we are now with the likes of Zoom. So that makes a difference. Where that also made a difference early on, and is still certainly something of consideration, is closing deals. There was a period where a lot of investment houses didn't know how to close deals during the first lockdown, because again, on the investment front, venture capital particularly, you're investing, as we said, in the team, in the people, as much as you are in the business. So investors want to sit across the table and talk to them, to get to know them personally. That's much more possible to do when you meet in person than when you talk over Zoom. So there was a real hiatus in the broader investment space, where investment funds couldn't quite get to the point of agreeing and investing, contracting. There was a tipping point where, of course, everybody spent months looking at deals, talking them through, appraising them, saying we'd like to do this, but not quite sure how we get it over the line. People's patience wore thin, and they had to find a way of doing it. Someone had to take the leap, and they did. And now more and more deals get done without people ever meeting in person. That's going to change, of course. Next year, we see things getting back to a more personable level, but I do think that this sort of interaction is going to form a much more pivotal or core part of the initial DD that firms do on investee companies.
So it's the limitations in terms of the communication side then between the clients and the investors. So in terms of the economic limitations, obviously, it's not the best time to be investing at the moment. So have investors become more reluctant, have you seen, over the past few months to invest in these companies?
No, there was a period going back, as I said, that early part of lockdown. It was partly there was a lockup because of the points we just covered, but also because a lot of funds, PE funds, venture capital houses, smaller private investment houses, they have money in a lot of portfolio companies, and especially for the VCs, in fact, those companies by their very nature can be early stage, so they're sensitive to market shocks. And so they paused on putting money out into new investments just in case they had to nurture those in their portfolio. Where we are now, there's been a lot of innovation. Lockdown and the way that it's redefined life, and some of those aspects are going to stay with us. That has led to new innovative businesses. There's a lot more online or subscription or somehow tech, non-physical, essentially. A lot more businesses have either sprung up or have pivoted to be non-physical or less physical. And those are the new opportunities where investors are putting money. So there's plenty of money out there. It's certainly getting active, staying active, and not looking to change for now.
So is that quite a new trend, or is there a gradual shift that was maybe pushed, encouraged further by COVID-19 to have more tech-focused businesses?
It has certainly across the board pushed towards a tech foundation to many more things. That's, not just from the investment perspective, but for businesses to survive. Businesses, as I said, we will deal with some businesses where we'll determine that a structured debt finance solution might be better than bringing in investment. Now, those businesses to survive may well have to shift some of what they do to have more of a tech focus just to survive in the current environment. So yeah, certainly that is across the board now, and you would argue that many investors want to see that there's some degree of tech underpinning a business before they'll put money into it, simply because most pure analog, if you want to call them that, firms will struggle to maintain size and growth without having some sort of digital base right now.
Is it harder to analyze the tech-focused firms, though, particularly given that it's very intangible, and a lot of them end up being loss-making for quite a number of years before they turn a profit?
Yeah. As I was saying before, that was the discussion that I was having with an intern today, and it was around how do you value a company, especially early stage. And going back to the Revolut example, as we made a bit of a case study out of that. The investment advisors going on the follow-on rounds, raising capital for Revolut, they have applied a 25 times revenue as the multiple to value that business. Now, what fundamental is really underpinning that? In terms of profit, so therefore your balance sheet and your true economic value, there's just nothing there. And that is a challenge that all companies, for one thing, because they have to convince others that they have a value, but also from the investment side, it's a challenge to determine where you can attribute value. You remember WhatsApp was purchased and it wasn't revenue generating, will never make a profit because it isn't something that can be highly monetized. They tried it and realized that they will most likely lose their user base if they do try and fully monetize it. But they had to attribute a value. So they said $1 per user of WhatsApp, and that's what it sold for. So it's a challenge, yes, for every investor to look at a tech company, unless they have sales contracts. How do you attribute value to a piece of software that might be very good and proprietary, different from everyone, but if it's not yet producing revenues and profits at its full potential, how do you really put a value on it? And that becomes very discretionary.
Do you also find that businesses tend to seek advice at the wrong time, so maybe too early or too late in their sort of growth cycle?
Yeah, both. We see businesses come too early, and that isn't necessarily a bad thing, as they get some advice. I spoke with a young chap 2 days ago, and he was running a small business which he was doing in a fairly manual sense, and it was trading goods, and he wants to take it to an app digital format. And what he intends to do is quite a good business model, but for us and for many VCs, he's too early because he hasn't yet created his MVP. He hasn't got an operational product to prove that the market will actually pay for what he is offering. And the term startup is used very loosely around companies that are not yet set up. Startups in the VC space are companies who have started up and are growing quite quickly. They may not have profits, but they've started up. So in terms of too early, yes, we do see them. As I say, it's not necessarily a bad thing. Then we see some that come too late, and that can be sometimes not a very good position for that company. They may be in serious financial problems. They've come to us to raise funds to try and plug gaps, and we end up having to provide them with very different support, maybe restructuring financials, but they can sometimes be in a position where they end up having to shut down that business because they've waited far too late to get that problem solved. Others might be a bit too late in terms of the VC investment mindset, which is very different to what I've just talked about. That could be that they have valued themselves by taking in early round investment at slightly too high for what many venture capital firms are willing to buy in at. VCs like to be in early so they can take a very pivotal role in shaping that business. So some businesses will find themselves in between the VC and the PE world whilst they try and scale.
So is there an element of reluctantness, of entrepreneurs being reluctant to seek these services? Maybe they feel like they're sort of relinquishing control of the firm that they set up, and they've had success so far, so they feel like their decisions optimal and they don't need these services.
Yeah, that has been a relevant and changing dynamic over the past couple of years, and there's been a number of fairly large companies, startups, going back to the Revolut, Monzo examples. The startups, but they're pretty massive now. They've got extreme levels of revenue going through the accounts. Now there are some businesses where VCs are being left behind because they're managing, that business is managing to scale up without pulling in third-party investment for the reasons you just said. They don't want to dilute their shareholding. They don't want to dilute the level of control that they have. And if they can see a way to keep building the business and the value of the business without a VC coming in and taking not necessarily a controlling position, but a position of real involvement, if they can build it big enough without that early involvement from a VC, it puts them in a stronger position to go out for money at a higher value and to somewhat dictate terms on which an investor will come in. And there's been more and more businesses working towards doing that because they can see exactly what you just said, that if I go too early, I may relinquish a bit more control than I ideally want to.
So I noticed that Axial emphasizes its entrepreneurial background. So do you think that's quite an important thing for staff working in private equity or in a role such as yours, boutique advisory, to have that entrepreneurship experience so they understand that perspective?
Yeah, I think that is really important, and that can be a differentiator actually between venture capital and private equity, is that VC is more focused towards that. A lot of VCs will be started by people who have built a business from the ground up and then exited. So they've got the money that they can start investing into other businesses, or they bring in people. You know, as they grow, they say, we need somebody else as an advisor or a portfolio manager. And they will look for someone else who has built their own business, understands really bootstrapping, raising money, looking for the efficiencies everywhere in a business, because you just have to when you're starting from scratch. And they might bring somebody like that into a VC. Private equity is slightly different in that they tend to buy out existing operating companies. So you may see more investment bankers, analysts, for example, going into private equity. Equally though, someone who wants to go and work in a VC that hasn't been an entrepreneur before may well be an analyst for the company. And that can be quite a different skill set. But yeah, people who are that way inclined, entrepreneurially inclined, are going to enjoy it quite a bit more, I think.
So does it work the other way around, that an entrepreneur maybe benefits from having a better understanding of a venture capital perspective or private equity perspective?
If they want to raise money.
Mm-hmm.
You know, if they don't need or want to raise money, then it might never be relevant. We work with some great entrepreneurs who have built up really good businesses, and they achieve really good profits, really good growth, and they come to us to raise money simply for even bigger expansion, and they have never looked at venture capital or at private equity before. And that doesn't matter, because their skill set needs to be their business, running their business in their market and growing it. And that's why they come to us. So we can bridge that gap between raising investment in the manner that they want it, and they can continue focusing on growing a business.
So before we touch on your on the career aspect of advisory work, it's good opportunity to say to people, please do put your questions in the chat and we'll get to them in just a second. So what are some of the background skills that people should have or should work towards if they're going to work in a role such as yours?
It is often good to have a good understanding of finance, because in the end, that is a pivotal part of what we are doing when you are raising capital. Understanding or being able to really demonstrate by the use of that capital, when the business deploys it, what sort of returns will it generate, need to be able to really graphically illustrate that through understanding cash flows, understanding when a business wants to raise investment, how much does it need just to stay above water. Often you may have heard of the J curve or the hockey stick effect that early stage companies have, where to really grow, they have to employ people, for example, take on new infrastructure. They might run into incredible losses before their market growth converts into positive cash flows. So understanding that financial side, and very helpful to understand how businesses work. And going back to your point about if someone is an entrepreneur or has been, will they be well suited to the VC space? Yeah, they're going to really bring a good skill set there, because they understand building a business. And people can get that without starting their own business. They might join somebody else's young early stage business and be a part of that growth process. So yeah, those sorts of skills, understanding financials, understanding how a business works, those are a couple of key skill sets. It could be broader as you get into much bigger firms, people who focus purely on economics. Some of the private equity funds that we deal with, a lot of the people there are much more economist and analyst based people, because they really pull apart the financial mechanics of a business when they work out how they're going to value it before they invest.
So if someone was know they want to go into the financial services industry, but they're not sure what they want to do, what advice would you give to students who are trying to work out what they want to do in the future within the industry?
try and get involved any way you can, really, with young companies. You might volunteer with a startup, just so you can understand the pains that they're going through and the rewards that they achieve when they get over milestones. That's something that many young companies can use, is the help of more people, but they can't afford to pay. So, you could get some free experience by giving back for free to these young companies. Networking in general terms, being part of the societies that you're a part of now, that obviously for 2020 was stunted quite a bit because people couldn't meet in person. But when that starts to come back online, similarly, as we talked about before, Zoom is a great way to chat with people, but really networking in person is a great way to get into conversations that you just didn't intend on having. One conversation leads to another topic, and you just start to learn a lot by being around people who are in the space that you want to be involved in, whether that is pure finance or growth companies, for example. You're on mute again.
Yeah. So we've got another question as we move on to a more Q&A focus section. So Yasmin's asking if you could highlight, if you've got an understanding of the risk assessment VCs will do before investing, or any other investor, private equity or institutional.
Are we back on?
Yeah, sorry, did I?
Yeah, so, it all completely dropped out my end then. So I heard that there is a question, and I didn't hear what the question was.
Okay, so it's whether you could please highlight the risk assessment investors will perform when looking at potential investments.
Yeah, and that ties in very well, actually, with what we were saying before about how do you value a company. And where that leads to, excuse me, is how does each different investor or fund value a company? They all will risk profile in their own way. So risk is subjective. If I am an investor in fintech and I understand fintech perfectly, and the business comes to me as a small growing fintech, my level of risk might be lower than someone who has no idea, or whose focus area is on online retail stores, for example. They may not understand pure fintech, so for them the level of risk is higher. As we said, when you value especially tech companies, when there's potentially no tangible assets there, it's one thing to try and find value per se within the business, then that will be impacted by how each investor assigns their own risk profiling. So that's one side of it, but then of course there's all the inherent risks of any business being, where is the security behind this business, if any? What does the marketplace look like? Some risks you just can't see coming. One of the investment houses that we work with closely, for example, invested in an events company maybe 3 years ago now, and they host international events. The trade exhibitors is their main focus. They could not have foreseen COVID coming. Now, how do you have a brilliant exhibition in a closed hall when you can't have people within 6 feet of each other? So it's looking at the market, looking at the macro level risks, and really assessing how the business might suffer an impact. Sometimes you just can't see it coming, but very important, yes.
All right, thank you very much. I think that concludes our session then, if no one else has any other questions. So thank you very much for your time. It was very insightful. I
Yeah,
hope we
good talking to
can
you.
keep in touch with Axial over the next few years. And good luck to everyone in the upcoming exams. So
Yeah,
thank you very
absolutely.
much
Good
for your
luck.
time.
Thanks. Bye-bye.
Bye.